Hey, what's going on? JT here. Is that live? What's going on? It's JT here. And if you've been following my videos, the first couple, I talked about kind of what my beliefs are as far as the morality, the moral outlook that reflects the lens through which I see the world and political and economic behaviors. So I got my new microphone. Hopefully it's working well. When you get on this, I'll probably ask someone how well it's working. But let's get into this. I wanted to first go over the app that I use to watch over these markets, and that's the investing.com app. So you can see here, when I pull it up, it's got my portfolio and everything I like to watch. Can't really see that well on the screen. But if you're watching this stuff, I suggest you download this app. You can get a quick glance of everything that you want to watch. You can make different portfolios, and the internet version, you can use a lot more different tools like Fibonacci's and support and resistance lines. But just for a quick glance at the charts to see what they're doing on a day-to-day basis, this app is freaking awesome. So anyway, we're going to start with market stupidity, because that's what I'm seeing right now. And a few examples that you may or may not know about. Let's talk about three. So one is the WeWork situation, owned by SoftBank, a Chinese banking company. And the second one is going to be Tesla, and the third one is Beyond Meat. And these are what I call irrational exuberance, right? Greenspan said it best: irrational exuberance. We're seeing just market stupidity beyond anything we've seen, except during times of extreme, I guess we call it madness of crowds, because that's the book I'm reading. And the only time we've ever seen the trailing earnings average, also known as the Shiller PE, this high was in 1929. We're at that level right now. And in 2000, which we're not quite that high yet. But if you look at the main tech stocks, they are at those extreme PE ratios, especially when we talk about trailing averages, right? So let's get into the first one. What did I say it was? SoftBank, right? They put a ton of money into this WeWork IPO launch, and then basically the the WeWork actually put out their numbers, and they had something like 11 million square feet of office space in New York City that was unoccupied, that they were renting. The whole business model was, it was smoke and mirrors, right? It was the exact same thing we see with Uber and Snapchat. And so we get this huge valuation. It was valued at, I think, $44 billion. They came out with their numbers, and the stock just crashed, to the extent that SoftBank had to give them like another $1 billion just to keep the company running, because it's completely useless. And then the second one is Tesla, which is up 150% in the last, year or something. And it just surpassed VW and all the other car companies as the highest market valuation. So their stock is worth more than VW. And let's put this into comparison. When you actually compare the sales of VW to the sales of Tesla, it's unbelievable. Tesla has less than 3% of the sales that VW has. That just screams overvaluation. I don't even think Tesla has ever made a profit. The only reason their stock is up is because they can borrow money at insanely low rates, invest it in research and development, and then get like a lot of stock investors like really excited about the idea. But ultimately, it's not a profitable company. Will it be in the future? Unsure. The fact that we're subsidizing it means that the government's backing it. So I guess eventually it'll be successful. But at what cost? How many other companies with better technology are not getting the attention that they deserve because they're not getting government grants and subsidies and the publicity that Elon Musk has, right? I don't think any of his companies are actually profitable. They're all government sponsored entities that should be bankrupt and go under. No matter what you believe, we should let the market choose the winners, right? And that also applies to every other company in various different spaces, right? So the entire fracking industry across the America, which a lot of people are really upset about, it's only functional because it's being subsidized by low interest rates and by government bailouts and tax laws and all this other nonsense that makes a non-successful company somehow make money at the expense of taxpayers, at the expense of investors, and who's getting rich? Elon Musk, every CEO, everyone who's involved with that. But they don't even have a successful company. So that brings us to the third one, which is Beyond Meat, which I believe their market valuation is also like something comparable to Tyson Meats or something like that. And again, just like the other ones, Beyond Meat has something, I haven't looked at these numbers in a while, but something like, let's say 170 million in sales, while Tyson has 4 billion, and yet they're being compared in the same, like their competitors or something, and they have similar market caps. And this is what happens whenever a market gets frothy, right? So I mean, the S&P 500 is up 14% in the last 67 days. The only time that's ever happened is coming out of the bottom of like the 1987 crash or the 2008 crash. And so the market's just making these all-time highs, and the Federal Reserve is cutting rates into this and pumping $500 billion into the repo market last month, and increasing stimulus. The government deficit has expanded to $1.4 trillion a year, which is higher than it was in 2009 when Obama was stimulating the economy, which didn't work. It doesn't work. I mean, what low interest rates and free money do is they allow corporations to buy back their stocks at a really low interest rate, take that money, and when you buy back stocks, it pushes the stock prices up. And then the CEOs and the executives, they all get bonuses because stock performance is through the roof, but they're not increasing the sales of the business. They're not increasing the research and development of the business. And so what it essentially does is it guts the economy. It steals future profits and gives it to the current shareholders who are pretty much cashing out right now. Let me give you an example. Apple, for example. Apple has flat earnings for over a year, and yet their stock price doubled in the last year. If that doesn't tell you that the market's getting frothy into a bubble scenario, then I don't know what will, right? Meanwhile, gold and palladium specifically have caught a bid as far as the commodities go. And gold is up, from 1050 to 1550 now. So almost 50% in the last 3 years. Meanwhile, silver is just about flat for that period of time. But in a longer time horizon, what we see stocks and bonds and real estate all at all-time highs and making new highs. And so the retail investor, the average person, wants to get in on that and capture that gain. But right now what's happening is the corporate buybacks. I mean, we're running out of it. There's very few corporations who need to do buybacks. And so there's not a lot of buying that's going to be able to push this market up, except for the central bank intervention. And, pension funds are a big buyer of the stock market. What a lot of Trump supporters don't want to admit is that when he cut the corporate taxes by about $130 billion, well, that was supposed to mean more money in our pockets through the trickle-down effect or some nonsense. But what actually happened is, and I think this was planned, so it wasn't really Trump doing this, but more the overall economic plan of the United States government to increase state revenues, because the 120 billion or so taxes that weren't paid, so lowering taxes, well, the states have increased taxation by about $120 billion as well, because I think about 47 of the 50 states, their pension funds are completely underfunded. And they, of course, people are going to rely on that, and they don't want the government to cut pensions. So all the state governments are increasing taxes to put into the pension fund, so they'll actually be able to pay for the 10,000 baby boomers retiring every single day. So that's been, I think, a major participant in the buying up of the stock market, is just increased taxation, put into pension funds, and they're putting that into the stock market. And let's rewind a little bit more. Okay, why are pension funds putting the money in the stock market? Like that offers no stability. Okay, one, if the stock market crashes, then tax collection receipts, so the IRS crash, and that will increase the government deficit, right? And drive inflation, even though we'll be in a deflationary setting. And then secondly, because interest rates are so low and pension funds have promised 7% returns, the pension funds can no longer invest in bonds to get that 7% return, which was really easy back in the 80s when interest rates spiked to 19%. So now what they have to do is either put their money in junk bonds, mortgage-backed securities, CDOs, and all the things that caused the problems that resulted in 2008 crash, or they have to just put it in the stock market and actually leverage it just to get that 7% return that they promised. So fundamentally, the system is broken because it was based on the high interest rates of the 80s, when everyone started putting their money into 401ks, IRAs, retirement plans, and pension funds. Now that the whole system is dependent on low interest rates, the pension funds and the retirement plans, they aren't able to make that kind of return. And I mean, a lot of these funds are at 70 to 90% stock allocation. So a stock crash right now would result in, the destruction of both tax revenues and retirement accounts and pension accounts. And ultimately, what's the government going to do? It's going to print money. So it's either going to print a lot of money, currently $1.4 trillion a year, to keep the stock market elevated and to keep the system going, or the markets will crash and the government will come in with, probably, in 2009, they did a $5 trillion stimulus plan, which clearly didn't work. Interest rates are still low, and we're lowering them into all-time highs, which is insanity. But the next bailout program will be probably $10 or $20 trillion, because the system is so reliant on debt. And when that debt starts to be called in, basically when banks stop trusting each other and stop lending each other money, then the whole system freezes up. And the only way to prevent it from freezing up is to print more money. So what to do? That's the big question. I believe in buy low, sell high. So I'm heavily invested in silver and silver mining companies, because I think silver is the one market that is actually quite low. It peaked out in 1980 and 2011 at $50, and now it's at 17. Meanwhile, almost every single other market out there is at all-time highs. So is it a short-term trading play? No, it's more a long-term investment to protect your savings against inflation. Currently, the government reports we're inflating at, 2% or so. Realistically, I think that's more closer to 5%, because anytime oil prices spike or food prices spike or housing spikes, then the algorithm automatically takes those off of its calculation to maintain this steady low level of inflation, or at least reported inflation. But even at 2%, that means that every 10 years, your savings are losing 2% per year. And when we compound that, I mean, I forget what that comes out to, but I think in 10 years that comes out to around 22 to 28%, right? So if you're going to lose, we'll even do the lowest estimate. Every 10 years, you lose 20% of your savings. Oh my God, like, why would you save anything in US dollars if your savings are being destroyed at that rate, right? So now we've got 10,000 baby boomers retiring every single day. Every single day, 10,000 retire. And they've been saving their money for 40 years. But after 40 years of 2% inflation, that money is now worth, let's see, 20, 40, 60, almost 80% loss of value. Now, granted, it's probably been in the stock market, bond market, and all those things growing in value, but you're still losing the purchasing power of that US dollar. And so when you start to take it out, it's worth less and less. If, however, you were well diversified over the last 40 years and you kept even 5% of your savings in physical gold or silver, the exponential gains of the value of gold and silver throughout that time would have offset the depreciating value of the US dollar over that time. So with regards to long-term savings and retirement accounts, having that diversity in gold and silver helps smooth out your portfolio performance over the long run and maintain the purchasing power. And in fact, it used to be common for financial advisors to recommend 5 to 10% of your net worth in physical gold. And obviously that's not the case because no one talks about it these days. The only people that are interested in gold are every single central bank around the world has had the last few years have been record purchases of physical gold. And last year, gold hit record high prices in 72 different currencies around the world, every single major currency except for the US dollar. And the only people that are not buying record amounts of gold and silver in the entire world right now are the US retail investors, okay? And that includes our pension funds managed by Blackrock and Fidelity and them. I mean, Fidelity and Blackrock combined, they manage an insane amount of money, like 20 or 30 trillion dollars, or even more than that. I'd have to look it up. If they move their allocation to even 2%, which is the average, hell, if they moved it to 1%, it would double the allocation of US savings in physical gold. So, but the fact is, there's no gold on the market. There's none. The COMEX is the market in which gold is traded on a day-to-day basis between retail or speculative and commercial traders. And I believe the COMEX houses some 323,000 gold ounces. And every single day, there's like 500,000 ounces traded or something. I'd have to look that up. That's probably grossly inaccurate. But the point is, there's a massive amount of gold traded on a daily basis, but the actual amount that they have is like 1% of that. Okay. So if let's say Fidelity, let's say they manage 10 trillion in assets and they want to move 2% into gold. I'll do the math real quick here. 2% of 10 to 3 billion, 3 million, 2, 3 equals dang. That's a big number. I'm so bad at math. I'm good conceptually. I'm just bad at math. 1, 2, 3. 9 zeros and a 2. So is that 2 billion? Yeah, $2 billion into gold. How much gold is produced every year? Let's real quick, as each year. Each year, approximately 2,500 tons of gold mined throughout the year. Let's see the value of 2,500 tons of gold. A ton of gold is worth it's 32,000 ounces. So a ton of gold is worth just over 46.5 million US dollars. So let's just say $50 million. Now, Fidelity wants to put 2% of their assets into gold, which means 2 billion divided by 50 million. That's 40 tons of gold. 40 tons of gold. Okay, 40 tons. I mean, the US is the biggest holder of gold. The government, and maybe, like, let's put a maybe there. They say they own, 8,600 tons. So let's just say 8,500 tons or something. So the US government has 8,500 tons. The next biggest government is probably, England or Switzerland with, 2,000 or 3,000 tons. And for Fidelity to put 2% of their assets in gold, they'd have to buy the entire world supply of gold production. Holy shit. 16 times over. The entire world supply, 16 times over. And that's that's one firm putting 2% of their assets into gold. So you can see that this market, if the inflation actually starts to pick up in this country, you're going to see institutional investors fearing that inflation start to move into gold. And so, I mean, there's about 20 major trading houses like Fidelity and Blackrock who manage something like 80 or 90% of the world's wealth. All it would take was one to move into gold. And we're talking prices of, I don't know, 3,000, 5, 10, 50,000. Not really, there's no way to possibly calculate this, but, currently the world has, I think, $253 trillion in debt, corporate and government. And I mean, there's only like $10 trillion of base US dollars that have been created. All of the rest of the money has been created as loans by the big banks. So if we get any kind of liquidity crisis, we're going to see a lot of that debt start to collapse, which will result in massive deflation, just like we saw in 2008. But I don't think the government will allow that to happen. They will do everything possible to save the stock markets and then keep their whole economy alive. So, I mean, gold and silver, it's a no-brainer. Like, everyone should have some gold and silver. I'd say minimum 5% of your net worth in physical gold and silver. I have 100% in silver and silver stocks. I'm not recommending you do that. It's because I don't have a lot to lose necessarily. But the accounts I manage are heavily overweighted in that sector. And the hardest thing is to see what everyone else is doing and do something different. That's what we struggle with as a society. It's natural for humans to want to copy. They want to be part of the herd. We want to be, safety in numbers. But right now, and you can just look back through history, humans, it seems like the more people are involved, the dumber the idea, right? And so currently, everyone is buying up the stock market, the bond market, the real estate market, housing flips are going crazy. And no one seems to be actually looking at what's undervalued and what the projection of our current economic system is. And, it's like simple math, the government owes 120 trillion in liabilities, and our tax receipts are around 3 trillion a year. And we're increasing that by 1.4 trillion a year. How are we going to pay that off? Yeah, nice. I'm glad you're into silver. Do you actually own it though? Do you have it? Because that's when it gets good. I tell people actually holding gold or silver in your hand is one, it's cool because that's something that's held value for all of history, and it always will. Two, if you actually hold it, not even having a company hold it for you, which I have that as well. But if you actually hold it, no one is responsible to give you that, right? So I have some silver in vault in Utah and in Singapore, and if the system collapses, maybe there's an internet crash or economic crash, and I ask them, hey, can you ship me my silver? Like, will they actually do it? Do they actually have it? Who knows? They're supposed to, and hopefully people are trustworthy, but you really don't know. And then thirdly, whenever you hold gold and silver, you feel like a pirate. So that's why I love it. Nice. Yeah. And, you know, there's stories about a guy I read who was living in Germany in the 1930s. And his parents were sending him, like mailing him like 1 gold ounce every month or so as his salary, you know, which right now, you know, would be like $1,500 a month from your parents to study abroad. That's a reasonable amount of money. But because they were sending him gold and not fiat currency, when the Weimar Republic went through the hyperinflation of the 1930s, he was there buying up every single house in his neighborhood because people would give away their house to get just a little bit of real money so that they could afford to travel, get out of the country, buy food, stuff like that. So it's kind of cool. I don't want to be too much of a prepper, but holding physical gold and silver right now is not only good preparation for the worst case scenario, which would be a liquidity crisis where people can't get their money out of the bank. And I'll delve into that a little more. But it also like it's a great speculation right now because the governments are bankrupt and they're going to print money to save their promises. So it's not only safety, it's also speculation, which makes it the perfect asset to own right now. Even though it's not popular, if it starts to be even mildly popular, the changes will be very dramatic. Speaking of bank runs, currently Lebanon is experiencing a bank run. There's protesters trying to burn down the central bank right now. I consider that exciting because I think central banking is criminal, right? And I talked about that in previous videos. Maybe I'll do a video just on the central bank. If you haven't watched it, go watch the video. What's it called? The Biggest Scam in the History of the World by Mike Maloney. Go watch it like 7 times until you get it. What else is going on? China has such a liquidity problem that employers are actually printing up their own currency. It's like an IOU. It's like a bond, basically. And they're paying their employees with these IOUs, fake currency, because they don't have any money. Okay. There's something like, I could be off, but I think $250 billion of IOUs floating the Chinese economy. If one of those companies goes under, the value of all of their IOUs will go to zero because no one will get anything. There's just so many different spots around the world that are collapsing under this debt load. It's only a matter. Here's a great phrase from Rick Rule: collapse, or at least a return to normal valuations, is not necessarily imminent, but it is. What's the other I word? It's not imminent, but it is, I guess, definitely going to happen. Yeah, like there's no way we can avoid this debt bubble. So anyway, before I close down, do you have any questions? That was just an overlook at the general markets. I will be doing some videos. I had a request. I did that gold video 2 weeks ago, and someone who's not familiar with looking at markets and charts was confused. And honestly, I thought I was trying to keep it pretty simple, but I suppose I've been doing this a long time, so there are a lot of different things that many of you may not understand. So I will be doing kind of a training, how to read markets and how to use all the different tools. I'll do kind of a training video series on that. Just like as simple as I possibly can, so that if you're new to this, you can get it. And if you're familiar with it already, then you don't need to watch this. Any questions, George, before I shut this down? Share it out. It went way longer than I thought it would, but there's just so much to talk about going on in the world. Someone's texting me. Let's see, any other markets we should be watching? As far as short-term trading in gold, I did get back long today with triple leverage stocks because we seem to have made a completion of an ABC pattern on silver with a nice rally in the end of the day. And gold made a higher low on the hourly and 5-hour chart and now the daily. And so that's good confirmation. The gold miners did great. They broke out above their recent high points, and they also formed a higher low and a higher high. So it's really hard to buy after a couple months or, well, a couple weeks of falling prices because it's like, oh, it could go lower. But when you see some of these signals, you have to go long. And I have to give some credit to Gary Savage over at smartmoneytracker.com because he has really nailed the cyclicality. I don't know, the market cycles and the timing and how to know when you're in, maybe not the exact bottom, but near the bottom as far as the timing goes. So you can really profit off those short-term trades. Hey, kitty. So anyway, if you got any questions, post them. I'll add them into the next few videos. And thanks.